I'm Charlotte McLeod with the Investing News Network, and here today with me is John Kaiser of Kaiser Research. Thank you so much for being here online with me today. Great to have you back.
Charlotte, thank you for having me back on Investing News Network.
Of course, and we have a lot to cover today, but I think where we will start is with gold. We actually last spoke quite a while ago, back in the summer when gold was at its great heights. You've actually been telling us for quite a while that you expect repricing that will take gold much higher than it is, much higher than we saw even last summer. I wanted to begin by asking, with gold now below 1900, are we still on track for that repricing?
I have a slightly different view now. My view last year was premised on the extreme uncertainty being created by the America First policies of the Trump administration at the time. They were dissing their allies, cozying up to autocrats, not really making the China-US situation any better. And it was helping accelerate the marginalization of the United States as the biggest economy, the superpower, and gold was trending up in expectation of this getting worse and worse. With the administration change right now and Biden's efforts to repair the relationship with allies, that stress has subsided to some degree. However, the recovery process that will be required when we have the COVID pandemic behind us, I mean, Biden inherits a debt trajectory that by the end of his 4 years, it will stand at 25 trillion based on policies put in place by the Trump administration. And that's not going to change. So whatever else he adds to it is going to take it to $30 trillion. And there'll be a debt component that keeps growing and growing and will increase the argument for owning gold. So it shifts back to this idea of gold as an inflation hedge, concern about the fiat currency, all this kind of thinking. So the repricing into the $2,000 to $3,000 range could happen. And there's also talk about this is not going to be like at the end of the roaring 20s where we go into a depression, but we're actually going to enter into a roaring 20s type decade where there's going to be massive expansion, a growing economy with inflation manifesting itself. And that, again, that creates up the prosperity argument for gold becoming, this place where you just park some of your wealth as an insurance policy. And so my old argument that as global economic growth gets back on track, gold's, the conflict between China and America is not going away. China's not going to retreat in terms of relative strength going forward to the United States. So the prosperity argument for gold going up, because you can only produce 90 to 100 million ounces a year with the current infrastructure in place, that will also drive gold higher. So I am bullish on gold. What puzzles me is why this market is looking at $1,800, $1,900 and going, blah, why the gold producers are down. It's like, what is wrong with you guys? At $1,800, $1,900, that's about a 25% real increase from the $400 in 1980 inflation adjusted to the present, which should only be $1,300. I don't think it has really sunk into the market that gold at this level is really important for deposits that are not yet developed, and it lowers the bar for exploration, what counts as a discovery. This has not really kicked in yet, and I think sometime later this year, this will happen. There is, in fact, in my view, a concern that gold's gonna fall back to $1,400 where it spent the past decade. That to me seems to be the bias in the market based on what I'm seeing in the juniors.
Okay, yes. And the juniors, I do really want to talk about those because I know that's one of your areas of expertise. As we've had a higher gold price, even though it's down right now, it has been elevated this past year. We've had higher commodities prices as well for other metals. Are we seeing that reflected in the juniors, or can you talk a little bit more about if that's perhaps still to come?
What was really incredible was after everything plunged in March, when we suddenly realized, oh, COVID is real, it's bad, the lockdown response is economically devastating. US employment soars to 15%, and it's still at 9% or so and rising again because we now have an even bigger infection wave from the Thanksgiving, Christmas period, the traditional Northern Hemisphere flu season from October through April. We're still working through that. We have the vaccine now. We do have to worry about mutations outrunning the vaccine so that the current round of vaccinations won't be effective. But in May, June, when gold took off as they realized the scale of the money printing that was being done just to rescue the economy, we saw an incredible funding binge for the resource juniors. This was the best financing window we have seen for resource juniors since about the second quarter of 2011. It's not as big as it was in that 2009, mid 2009 to early 2011 period when gold had first touched, almost broke through $2,000 and silver was knocking at $50 a door price. So this was a significant event, and a lot of this money is still in the treasuries of the juniors because of the backlogs in the labs. And the delays in getting permits and having to work out the protocols so that we don't infect First Nations communities in Canada, and also because of the difficulties in South America where lockdown responses have been quite severe. A lot of the money raised has not been spent, and a lot of the results are still coming in. We're still waiting for results. And so the system is the healthiest it has been in a decade. And I think we will see another wave of financing this year. The big concern right now that's kind of holding the market back is the bubble nature of it. During that third quarter of last year, the value traded of TSX Venture resource listings, it soared into the 50 to 65% of total traded value. But in the last quarter, after gold had stalled, and then it became clear that Biden was going to be the new president, the non-resource listing traded value has soared, and the resource listed value is down at sort of 35%. It's still substantially higher in total traded value, like we're trading $100 million worth of resource sector stocks, but the money is the risk capital is going into all this other stuff that's all over the map. And the concern is that this is like the first quarter of 2000, the last quarter of the dot-com bubble, and that this will all come apart and it will take our resource juniors down with it. So there's a nervousness amongst the resource juniors that's holding things back a bit right now. But I'm optimistic that once we navigate past into the second half of this year and we have evidence that the vaccine is working, pandemic is behind us, we will have another huge, perhaps even a summer funding boom like we did last year.
Okay, quick follow-up question. If you're an investor who's surveying this landscape among the juniors where there are companies that may have money left over from last year, companies that may be waiting for results or waiting to do work, how should you approach that if you're somebody who wants to put some money into the market?
One of the things that's haunting the resource juniors right now is the concept of opportunity cost. Because there is this dividedness between whether we're at the beginning of a 30s depression or a 20s style roaring 20s, people don't want their money in a stock that is not going to flow information that changes the fundamentals about the company. So it's very important right now to look at companies that are able to do work now and have the results start flowing in the second quarter. For example, Golden Triangle companies can't start work until late June, July, and they won't be flowing any results until the end of August, early September. So I'm ignoring Golden Triangle stocks right now and focusing on the ones that can get winter programs going. And this would be the Ontario, Quebec companies, juniors, where the lakes are frozen. In fact, an unfortunate thing this year is that Canada has had a very warm winter. Everything's delayed by 3-4 weeks. It's only getting frozen enough to move on to the ice and the bogs and swamps right now. So those are the ones where I am focusing my attention on. For the people who are really patient, they can buy the Golden Triangle stocks now, but then they're also exposed to getting walloped if we do get a generalized market meltdown, a retreat in general. And a major market setback would actually be a good thing, not a devastating collapse like what looked like was happening last March, but one that simply pulls back and say, okay, pandemic is over, now we start to rebuild. Then we get rid of all this, everything's so overvalued going forward. But one interesting thing about the difference between, say, the dot-com period is there is a significant shift going on in the way people view where does your cash flow come from? How does it evolve? ESG is now a buzzword, environmental, social governance. The institutions are all becoming activists in this regard. They're looking at the companies, making decisions. Are you just raping and pillaging this planet to make just-in-time cash flow for your next quarter so your stock can go out? Or are you organizing your affairs for a better future, not just in terms of climate change mitigation, but in helping this world? Even at Davos right now, they're all sitting there saying, why did just under half of Americans vote for a president who was mean-spirited and nasty and vindictive? Well, it isn't that they really like that. It's because they're angry that they have been left behind by the way globalization has, reorganized the manufacturing sector, adopted just-in-time type policies. So there is a shift going on to getting more redundancy, and this wanders into this whole area of security of supply, reshoring back into operations, manufacturing into North America, and weaning ourselves of our dependency on China. And this shift, it's a structural shift. It's also a transformational shift. It means bottom lines are going to suck, and they already suck because of the pandemic lockdowns and the curtailment of consumption. So the market might be willing to tolerate really high PE ratios on that for a lot longer than they were willing to do in the first quarter of 2020 and 2000, and then they started cranking the interest rates up too. Well, the Federal Reserve has already signaled that we are in no hurry to mechanically crank up the interest rates. We're going to keep feeding this. So we may not get this big setback, but a small setback would be like the green light to, okay, let's get going with the resource sector.
Okay, we have a lot of things to unpack there, I think. And where I'd like to start is with the connection between ESG and security of supply, because definitely those are two narratives that are coming up more and more often. And just before we started this interview, you were explaining to me exactly how they come together.
In the past decade, the China super cycle, it was actually a leftist talking point about capital shifting production capacity to China, where they have all this cheap labor, where they have no emissions controls, and you can make stuff super cheap. You import it, you sell it to Walmart. Everybody suddenly has a boost in their standard of living because with their ordinary paycheck that's not growing, they can continue to consume all of that. And this narrative, the Republican Party ignored it, the Democrats ignored it, but Trump paid attention to it and he tapped into it, which is how this whole Trump phenomenon got legs. And the resentment of these people, all these workers whose cities were devastated because manufacturing moved elsewhere, that is real. That is there. And China, meanwhile, it grew from a so-so economy in 2000 to now closing in on the United States. It's the world's second largest economy. They dealt harshly with the COVID pandemic right away in a way that cannot be done in a democracy. They are an autocracy. They are now rebuilding, and their goal is to dominate the world. But the world is realizing that this resentment, this anger amongst the 99 percenters, it's not going to go away. It's going to be with us. We have to do something about it. And they're also looking at the China price. I mean, how do we move manufacturing back to the United States when it's going to cost more because we have higher environmental standards that are actually enforced? It's not so easy to bribe the local official to ignore the fact that you're actually dumping everything downstream on your victims. And we have health and safety standards. And we're now talking about a minimum wage that's supposed to go up to $15 an hour. And all that is going to make everything more expensive. And this is where the ESG concept comes in. Not everything is going to reshore to America. Walmart will still be selling a lot of basic stuff, but higher end stuff, the consumer, this is going to become a major force. And the United Nations publishes this annual emissions gap report, late in the year, every year. And this year they pointed out, we got a little bit of a windfall in lower carbon dioxide emissions for 2020 because of the lockdown, but that's going to make hardly any change once everything goes back to normal. There's an emissions gap coming in 2050 that is substantial. And of course, we have this problem. I characterize it as the runaway tram problem, where we have the post-boomers wanting their future secured for 2050, and we have the boomers who are not going to be around to suffer the consequences of a greater than 1.5–2% temperature rise. And people my age are not so excited about sacrificing things as we take on new technologies that cost more, that force me to do less with everything that I have. And this conflict has seemed to be an irreparable thing, requiring a massive sacrifice by the older generation, which they don't want to do. But with ESG credentialing, if you're a 1%er, and the United Nations report observed that the world's richest 1%, they have a carbon footprint that is double that of the bottom 50% of the world. And if they were to reduce that 30 times, in other words, to about 3% of what it is now, it could make that difference in that gap. Because right now, all the plans and things that are in motion, we're still going to have a gap to get to that 1.5-degree target. But there's a new development. Robert Friedland talked about it, the AVAX exchange. It uses blockchain technology to create an online market where somebody who produces materials, and it's of course relevant to the mining sector with this purity and that purity, but it allows the attachment of certified ESG data. And that does not really exist right now, because you buy your nickel sulfate that comes from somewhere in Asia. It's blended from nickel coming from all kinds of dirty sources and so on. And when the branded company like a Tesla says, oh yeah, or Apple says, this is all nice and clean, everybody says, BS, you're just greenwashing. You can't prove that you're not sourcing this from some horrible, horrible place. But with this new type of data, the companies, the manufacturers who have a brand to protect, they can actually buy it from these suppliers and say, yes, our Tesla model, whatever, has all these ESG credentials. And yes, it costs more. We have to pay a premium for this because it's an auction system. Volkswagen competing with us too, because they want their Porsches to also, have good ESG credentials. And the consumers, the 1%ers, going there and redistributing their wealth and just handing it to everybody else to subsidize them taking a hit because we adopt new technologies, that isn't going to fly. But the 1%ers can make a decision, okay, I'll pay a stupid price for a Tesla and I'll start driving it. And it doesn't really hurt my standard of living like it does the bottom 50%. So I'm making a sacrifice that economically makes no sense, but I'm kind of paying it forward to the next generation, the younger people. And this, I think, will become a significant factor going forward as the one percenters start to take actions. And this becomes a justification for shifting manufacturing back into the sort of Western jurisdictions where there are higher standards and all that. It allows higher prices for the top end stuff to basically subsidize this shift. And with solar technology, 15 years ago, it was one percenters who put these panels on their roofs. It didn't make economic sense at the time because it was so expensive, but that encouraged all the manufacturers to do R&D to make it cheaper. Now anybody can put it on their roof. It makes sense. It's cheap enough. It makes sense. And in the same way, the one percenters are going to drive this technology revolution to shift us away from the carbon dioxide dependent technologies such as fossil fuel consumption. So this is good for the resource juniors because they're dealing with smaller projects. They're dealing in safer jurisdictions that are more regulated. And they're going to have a product that's not as profitable as something in some part of Africa or whatever, where there are no ESG protections whatsoever. So I think this theme is in the background, and it's going to make a major difference, and it will allow us to shift away from dependency on the lowest cost jurisdiction, the China price.
Okay, well, thank you for that explanation. That makes a lot of sense. In addition to looking at the connection between security of supply and ESG, security of supply for metals also has a connection to China, which you've been talking about, which we've talked about previously. I want to talk about that as well, because it kind of has to do with the tension between the US and China that we've seen during the Trump presidency. Now that we have a new president in place, does that US-China relationship change? Does the supply security narrative in the US change at all? How do you see that?
Everything I see is that it can't change. And China, you've heard of the wolf warrior strategy. They've shifted from just sort of, being quiet and biding their time to now becoming aggressive. They're beating up on Australia because Australia dared to say, we should investigate how you guys managed to let this virus get so out of control. So they are using tariffs and that to block Australian imports. They're starting to punish other companies. They're allowing their social media wolf warriors to go out there and bash other sides. They've made that switch. They're very aggressive also in the satellite area. There's some big articles in the last while about how the Chinese, in essence, engaging in a space war, where if you take out, say, all the American satellites, all of a sudden you change the balance of power. Hackers, they claim it's Russians. It's probably also Chinese, have penetrated the US control systems. They're inside the United States, and they are clearly using their strength to bully foreign manufacturers that are based in China. So this tension is not going to change under the Biden administration. It is only going to get worse. There's going to be less, trying to aggravate things, but this is going to remain a problem. And we're seeing it with rare earths. Rare earths, we had that big bubble 2009 to 2011 caused by China restricting exports. But now the EVs are taking off, and that's a big story. Is in 2016 we had lithium, cobalt, all these things take off because the EV concept, everybody says things are going to happen. Then it stalled. But despite the Trump administration and the pumping of internal combustion engine cars, the EV sector, the car makers continue to build, and now it's growing faster than expected. And rare earths continue to be part of electric vehicles, and lithium is going to be part of it. And if they can actually make a solid state electrolyte in the lithium ion battery, you might even be able to use lithium in the anode. And then you end up probably needing a lot more lithium than was projected. So a lot of these metals that either pass through China or come from China, this is a serious problem because China itself also needs to build out the electric vehicle system because the dependency on oil, it is an oil importer. That oil has to flow through the various narrow channels. And if China's oil supply were to be cut off through an international conflict, it would have a problem. So it will use coal to create electricity to do this. But all the materials that are needed to build out its own electric vehicle fleet, it's going to want that. Heavy rare earths are a big area. It comes from ion absorption clay deposits. These are superficial deposits. You can't dig deeper. You scrape them off the surface of the earth. It's gone. Last week, China finally floated a proposal to get serious about regulating the rare earth sector. And of course, Bionoble is already a giant blob, so it doesn't need to be regulated. They're talking about the heavy rare earths because they are wastefully produced. China itself will have its own supply problem. And all of a sudden, everybody outside is waking up and saying, oh, we need rare earth supply, both lights and heavies, coming from outside of China. So we're seeing rare earth mania 2.0, which I think we've talked about in the past few years, finally starting to become reality. So developing domestic sources for all these various metals, such as these 50 the U.S. has put on its critical mineral list, this is becoming very important. And one avenue that's very significant is all these mining processes that exist that create these fluids that dissolve the rocks, especially these leaching operations. How much metal gets dissolved but is lost and not recovered? Recover is one of those R words that the green movement doesn't really use, but recovery. What can you recover that is not being recovered right now from existing operations? That's going to become also an important theme.
Okay, that's a lot of good information for us. We're getting to the end of the questions. I have one on a specific supply security situation that I want to bring up. We had recently the news that Rio Tinto is looking to become North America's first producer of scandium oxide. And you're the first person that I thought of when I heard that news because you've talked to us before over the years about scandium and how it's a metal with a lot of potential exciting applications, but not a lot of supply. So I wanted to ask if this is something that will change the market for scandium.
The Rio Tinto development is a game changer for the scandium sector. Everybody knows that scandium alloyed with aluminum does wonderful things for aluminum, makes it corrosion resistant, makes it stronger, a variety of other things. But because it's a dispersoid, it's quite abundant in the Earth's crust, like 22 parts per million, which is far more abundant than lead. It doesn't concentrate. And so that has been scandium's problem. But with these discoveries in New South Wales, or these laterite deposits that run 300 to 600 parts per million, and now there's these magmatic deposits being found in places like Quebec and Finland, which are in that sort of 100 to 200 ppm range, it becomes feasible to imagine primary supply of scandium, but it has a chicken and the egg problem. Because to get to something like, say, Scandium International's Ningin, to put it into production, you need to raise $100 million. But you're not going to get $100 million until you have offtake orders for those 35 tons that they plan to produce. But the off-takers, they're very interested. They play with this stuff and say, yeah, we could use this, and this would be great for like lightweighting, making components in our Tesla lighter so that our batteries have longer range. But what? You can't deliver it next month after we placed order? You mean you have to raise $100 million and build it and then commission it and make sure it actually works so that you can sell it to us and make a profit margin so that you can continue to do it? Well, call us when you've got this problem solved. So the only way to solve this is through an incremental increase in supply. And the Rio Tinto story is fascinating. For decades, they have mined an iron titanium deposit called Lacteo, which is up on the St. Lawrence River. And at Sorel-Tracy, which is about 50 kilometers northeast of Montreal, they have this smelter. And they literally take this ore there, they melt it down, they strip off the iron, And the other stuff, and whatever slag they can get rid of, but the other stuff, the titanium, ends up in this material they call 80% titanium dioxide slag. And they've been selling this to the pigment makers for decades and decades. But the pigment makers have shifted to a different technology, which requires 90 to 95% titanium dioxide feedstock. So Rio Tinto was in danger of losing the market for its titanium byproduct. And they put R&D to work. They got their scientists and their process engineers, and they figured out how can we upgrade this titanium slag to the 90-95% rutile equivalent that the pigment makers want. And they succeeded. And as a byproduct, they figured out that there's a whole bunch of scandium in here that we can separate from the slag, the garbage that's left over. And my calculations are that they could produce as much as 50 tons of scandium oxide from this facility. Now, they've announced that they're building a 3-ton per annum demonstration plant that should be operational by June, and they've also said they can expand this to 12 tons per annum. I suspect it's probably bigger that they can do, but this allows them to feed this material to their Alcan division, which they bought for, I think, 40 billion or so during the China super cycle, and can start developing the offtake market. And so somebody wants, the military wants a small batch, boom, here you have it. And they can gradually build this up. And if they can get this going to sort of like 25, 30, 40 tons per annum, that's bigger than all this little byproduct supply that's feeding the market. Then it becomes feasible for, say, a Scandium International to raise the 100 million to add 35 tons on top of this. And the offtake market already gets it, it's seeing it. And then the 100 million is there in an instant along with the orders, and they can expand that to 100 tons per annum. And it's interesting, with this Rio Tinto news came out in May of last year, just after Scandium International itself announced that it had filed patents for recovering scandium and other critical metals from the raffinate of copper oxide mines. And there's about a dozen of them in the United States. Freeport operates about 6 of them, and they dissolve the copper through these piles, and it leaches in. It dissolves not just copper, but they only strip out the copper with solvent extraction. They've tried to recover the other stuff, but it was too complicated, so it just gets pumped back, mixed with more acid, and put back in a heap. And all those metals that get dissolved ultimately stay in that pile. So Scandium International right now is negotiating with the various groups there for a hosting deal where they set up a byproduct plant. And this would be able to produce ESG certified material, nickel, cobalt. Can you imagine Tesla getting its cobalt from a United States copper operation as a byproduct? It might be willing to pay more than it pays the $15 a pound that you get from Congo and God knows what warlords' little operations up there in the Kivu region. So both these tracks have the potential to build up incremental supply of scandium, so that together Rio Tinto and Scandium International could end up having 50 tons a year over the next few years from these separate tracks, which then sets the stage for building all these primary mines and opening up that 1,000-ton per annum market that's possible. And this has huge implications for using aluminum in a lightweighting capacity, especially in anything that moves where weight is a consideration.
Okay, well, thank you for putting that into context. That helps a lot. I think that comes to the end of the questions that I have. But before I let you go, I wanted to ask if there's any other themes you're looking at or advice you would give investors as we head into the new year.
I think we're going to see crazy valuations, as this is only the second year of a resource sector bull cycle that I believe will run 4 to 5 years. Understanding how the math of a resource project works is going to be critical. I have my rational speculation model, which allows you to quantify the size of the prize and then figure out what it's worth in net present value terms, and then also price it back to the stage of exploration that you're at and the uncertainty. And this is very different from all these winner-take-all widget type stories that now dominate the non-resource sector, which allow, very lofty valuations. The resource sector is hurt by the fact that there is a value limit to what a mine is worth based on its costs, its grade, and the metal price. And so that limits the upside. But we will go into another bubble period where stupid valuations kick in. So it would be good for people willing to wander into this sector to learn how to quantify the value of resource plays.
Okay, well, great. I think that sounds like a good place to end it on. Thank you so much for being here again with me.
Thank you, Charlotte.
Thanks. And once again, I'm Charlotte McLeod with the Investing News Network, and this is John Kaiser of Kaiser Research. And